Hans, you make the point that the expression "sell in May" could really come back with a vengeance this year, which is really sticking your neck out on May 24th when we've had 5 straight weeks of the Dow being down. So you did that. That's an awesome call. So May could be rough.
There's an addendum to that, right? Sell in May and go away. That when you look at that adage, basically the idea is you come back in the fall. So, which means that the summer period and early fall could be a pretty tough time, which I think it's going to be. And that's just a function of very sloppy earnings, the reality that we're not going to get a Fed rate cut. That's kind of wishful thinking. And we're going to be left with the reality of the situation, which is, we're sort of late cycle where we've got a number of different conflicts on fronts that are going to be impacting earnings. At some point, it's going to impact growth, but not now.
So you say that you're sticking with your 2,750 to 2,800 S&P target,
right?
You're sticking with it. So, have you had that since the beginning of the year?
Yes.
Okay. So when that first 3 or 4 months where the market's gained 20% up to 2,950, were you watching in horror as that was happening? As you were
disbelief, almost concussed.
And now it's coming back into.
It's coming back to where
you think it makes more sense?
Exactly. But we'll probably overshoot that on the downside at some point this summer. I think what we're playing for here is what you play for the end game, right? What does it look like at year end? And I think at year end, it's somewhere between 2,750 and 2,800.
You're at Fiduciary Trust, so I think that you take this fiduciary thing really seriously. And
130 years worth.
I've known you over the years, and you have always been. Would you say you're cautious? Is it the tie? What do you think it is? When was the last time you would say you are screaming, raging bullish? I don't ever remember you being like that on the show. And you may be right this time. I'm not saying you're not right.
A few years ago, remember we...
I don't remember. There was a time?
No, it was. I was very, very positive on small caps here in the U.S. Mid caps, that's where the better values were. Turned out to be a pretty good call. But I do think, though, that the environment that we're in right now, I mean, we ran 20% in 4 months on what?
Well, you're speaking directly about the equity market, multi-asset approach. I think, unfortunately, people fail to remember there's other asset classes in this capital market mosaic. High yield, investment grade, municipal bonds are all performing tremendously well. What's that signaling overall for the equities market, if anything?
Well, I think it's been a flip from what it was last year, as you recall. So everything was down last year. And so you get some relief or hoped relief from the Federal Reserve, at least in language, not if indeed. And it flips the sentiment. And you saw that risk assets were on right across the landscape. And I think that can only play so far. We've seen most of that, and now the complacency is running into reality. And the reality is that we're going to have probably the balance of this year, certainly on a policy front, it's not going to play out the way people had.
You're asking what caused that? I mean, maybe it was 3.2% GDP growth following a year that was 3%. Maybe it's sub 4% unemployment. Maybe it's productivity gains. Maybe it's
without a doubt.
I mean, it seems like there's a lot of great things to cause that. I don't.
That's right, and that's why I think you end up this year about 12% higher than where you started it.
And that's where 2,800 would be 12%.
12%.
Because of that December sell-off.
That drop.
Okay.
Yeah.